Welcome to this episode of Dividend Discussion. In this series, I really want to give every dividend investor a chance to tell their story. We're going to get to hear things like when and how they got started, mistakes made, lessons learned, and much, much more. My ultimate hope for this series is for the guest, you the viewer, and even myself to be able to take something away from this conversation to make us all better dividend investors. No matter if you're retired and living off of dividends or just got started yesterday, there's always something to share and even more to learn. So if you're interested in being on your very own episode, reach out to me via email at dividendobsession@gmail.com and I'll be in touch. But without further delay, let's get to the interview. Hello and welcome to another episode of Dividend Discussion here on Dividend Obsession. My name is Troy and today I have the pleasure of speaking with Michele. Michele, go ahead and give us a brief introduction about yourself.
Hi, my name is Michele and I'm recently retired. So I'm on the other end of the spectrum from a lot of folks probably watching today. So hopefully I can, give you some advice about things I've done wrong and things that have gone well. But yeah, I am recently a grandmother over the last 2.5 years. I have 3 grandchildren and husband's been retired for a few years now. So been investing since I was in my 20s. And so that's kind of where I come from. And I'm looking forward to our conversation today.
Yeah. Thank you for taking time to speak with me, and also congratulations on being a grandmother. That's pretty cool. Okay, so I mean, you touched on it a little bit. So you've been investing since you were in your 20s. So like when you began investing, like what was different about then? What is different now? And then like what got you into dividend investing specifically? Like were you a dividend investor from the jump, or did you like kind of mold into that?
Yeah, very different. I'd say it was in the 1990s. And, nothing was electronic. Everything was paper statements and whatnot. So I didn't know to open my own brokerage account. I think people usually worked with a friend of a friend, had a recommendation of a guy or a gal that you worked with.
Sheesh.
They opened the account for you. You didn't really have choices of what the money was going into, or if you did, you made random choices. Like I didn't really know. I knew I needed to open a retirement account. That's what I knew. I knew that, but even back then we were worried about, is Social Security going to go away? Those types of things. And so I knew I had to do something. My company did not have a 401k. So I had to open up an IRA, and I did. But it was like a fully loaded mutual fund that this person recommended I go into. And I did that for a little while. And believe it or not, it was like $25 a month. Like
Wow.
That's what I could afford.
Yeah.
It's like, okay, what can I afford? We were just starting out, and that's what I could afford. So one thing I would say is there's no amount that's too small when you're starting out. Just start.
Yeah.
and so I started doing that. And then I was always interested in business and investing. So I took a night class on investing, and then I started learning more about loaded funds and professional fees that I was paying and expense ratios. And I'm like, I got to get out of this. This is like, I could do this myself, I'll figure it out. And then that's when I opened up my own accounts at like Fidelity. They helped me move the money over there. And then I started having, a little bit more control, if you will. I felt like I had a little bit more control. It was still mutual funds, but lower expense ratios, they weren't fully loaded funds, things like that. So I felt I was doing a little bit better there. Eventually my company got a 401k. They didn't match, but I started using that. I'm putting my money in my 401k, and I wasn't in dividend investing at all. Like every time you answer those questions with your brokerage of what's your investing style, I was always like aggressive growth. I'm in my 20s, aggressive growth. And that's how I kept it for a majority of the time. Investing was just through 401k. Eventually I changed jobs and got a match on my 401k, and just kept putting it into whatever I would look every year. I did an annual review, and every year I would look and see which funds were doing the best, like historical performance wise, right? I know it's doesn't mean that that's how they're going to perform in the future, but that's all I had to go on. So I would say, oh, this one seems to be the best one that's growing the most, so I'm going to put my money there. And that's what I did for a lot of years until it got closer to retirement. And then that's when I started to think about income streams and things like that, and not just growth.
Okay, so a couple questions on that. Were 401, like I wasn't I was born in the 90s, so I wasn't working in the 90s, but like were you was like were 401ks not like as popular? Like they weren't offered by as many businesses, and for sure not the
Yeah.
match. Is that how that used to be?
Yeah. I mean, like my company didn't offer it. And then when they did offer it, they didn't offer a match.
Yeah.
So it wasn't like everybody had one.
Was there
I don't
education
remember.
behind that? Like the company says, "Hey, we're opening this thing. It's called a 401k. Like here's what it is.
Mhm.
Here's what it's designed for." Did they just like kind of like did it just show up and then people either did it or didn't do it?
Yeah, I mean, like I know a lot of companies now automatically enroll their employees
Mhm.
into a program. That wasn't like that. It was like, here it is. You can add to it or not. It's up to you.
Yeah.
So, I immediately started adding to it.
Yeah. And
Mhm.
what got you into like, so when I grew up, I told this story on a couple interviews already, but like when I grew up, I was just a saver. Like, and it's really hard to, it's not impossible, but it's really hard to save yourself the wealth. Just
Mhm.
because like you're doing it all the work yourself. There's no such thing as compounding when you're doing it yourself. So
Right.
like what caused you to like be able to, because it seems like it's not that popular, not that common. Like now it is a little bit more, but like I don't know how common it was for someone in their 20s to actually even think about retirement, much less start saving for it. So like how'd you get into that?
Yeah. Well, my dad used to have the envelope system. I don't know if you've ever heard
Hmm.
of that before, but it was like, hey, if your gas bill is, $20 a month, you put $5 a week in an envelope labeled electric bill or gas bill or
Hmm.
whatever. And that's how you budgeted and how you saved. And that's what he taught me. And I did that religiously. So I was a saver in that way. I was a budgeter. Um, I guess, I don't know. I mean, I just knew that retirement was coming one day. And like I said, I've taken business classes and things like that in school. And I was always interested in money. I was like, honors math student. So I
Hmm.
was always like number oriented. And I just knew that Social Security, you hear from your parents, oh, it's going to go away one day. When you're a little kid, you hear these things. And my parents were much older than I much older. I was born late in their life. So I was like, they were in their 40s, mid 40s when I
Hmm.
was born. So I was starting to see them getting older already.
Hmm.
And like them struggling with, staying in the black and not going into the red with
Hmm.
just like getting a Social Security payment and things like that. And it was like, this is going to come before I know it. Like I got to start saving for my retirement. What if Social Security isn't around?
Yeah.
And, that's when I, got that referral from a family member and just started with $25 a month.
Yeah. Well, so I don't know if you've seen my newest series on the channel, the Anyone Can Invest series. Like I just started that, and that's the whole
Mhm.
point of that. Like it
Yeah.
addresses the one of the issues, especially with dividend investing, is like if you are investing in quality stocks, not all of them pay monthly. A lot of them pay quarterly. And
Mhm.
then like
Mhm.
some people, when they first get started, they're like, oh, I don't want to get my 31 cents once every 3 months. Like I want to get it more frequently. So I was like, okay, we're going to do this. We're going to tackle the thing that you need to be rich to invest, because that's not true. You need to
No.
invest to get rich. Um,
Yes.
and so I tackled that with the Anyone Can Invest series, or I'm planning to
Yeah.
tackle that. And then also the way I structured the stocks, I should get paid weekly from those positions. It's just
Yeah.
12 stocks. They're all quarterly, but they're going to pay me weekly.
Gotcha. I gotcha.
So it's kind of one of those things, and I really like that you said that. Like you just started with 25. It is kind of
Mhm.
ironic that you said like about Social Security, because like that's the same thing you hear today. Is and honestly, so I'm not even counting on social, and I think you probably did the same thing. I'm not counting on
Yeah.
it being there, but if it's
Right.
there, I'm going to obviously take advantage of it.
Oh, sure. Yeah. I mean, I think that's the safe route. That's
Hmm.
the conservative route is pretend it's not going to be there and then you'll be okay.
Yeah.
Because you want to cover those expenses in retirement. But from being a saver like that, I think I was always like, but I was reading and buying like books.
Hmm.
I can't even remember the names of them now, but I was always interested in finance and investing. So I would buy books and read, about personal finance and things like that. And that got me more interested in investing. Yeah. So
I mean, of all the things you can like quote unquote waste your time on, I think it seems like the most fruitful thing to do, right? Like learn
yeah.
how to make more money and how to spend
Yeah.
less money and stuff like that. So it's
Yeah, you see a lot of people like, on Facebook groups saying, what should I do? What should I
mhm,
buy? And I'm like, buy a book about investing and
yeah,
read it and then come back and ask what you should do.
yeah,
Because
yeah,
then you'll have a little bit more, knowledge about the questions you're even asking,
yeah,
or maybe you're not even asking the right questions.
yeah,
Like so you hear a lot of people saying invest in yourself
hmm,
first, and
yeah,
I really believe that. So just pick up any investing book, and just start reading it, and you'll learn.
hmm,
And yeah.
yeah, yeah. I agree with that. Like it's I'm not like a giant reader, but it's really depending on like how you get your basically it's just absorbing more information, however you can do that, whether
Yeah.
it's the internet or whatever. But like what you're saying with those, I don't know why, but recently I've seen so many posts on those groups where it's just like, if you had $50,000 to invest
What
today,
would
what
you
would
do
you?
with it?
I'm just like, what? Like, this gives like there's not even close to enough
Scroll
information.
past it. Scroll
Yeah,
past
I'm
it.
like, there's not even like a close, like that's how you know. And like to me, that's a lazy question. So you get if you're going to respond, you give a lazy response. Well, like
Yeah.
I'd buy a lottery ticket. I don't know. Like I don't know. Like it's one of those things. Like it's just I don't know. There's so many. You can always tell. Like I'm into fitness too, so I can
Mhm.
always tell when certain people just like where they're getting their information, or they just don't know enough to ask the right question, kind of thing. Or if
Right.
they're just being lazy, like they'll see me working out, they're like, "Oh, like how do I get big like that?" Or whatever question they might ask, or how do I get that strong, or whatever. And I'm just like, dude, I've been doing this since 2012. Like I'm at
Yeah.
12 years in. It didn't happen quick. It takes all this. You have to learn your lessons. You have to take your lumps.
Yeah.
You're gonna get hurt. You're gonna have setbacks. You're not gonna always have motivation. It's all about like learning all those things as you go. I don't know that anybody in fitness or finance has ever started with the same plan they ended with. I don't think that's a thing.
Yeah. But I mean, the word you just used, plan, I think we need to call out,
Hmm,
because you have to have a plan.
hmm, yeah, exactly.
Just randomly going, what's the best stock?
Yeah,
Well, what's your plan? What's
yeah,
your strategy?
yeah.
And I
What's
think
your
that
timeline? Like, what do you
oh,
like? Do you
yeah,
want to
that all plays
like,
into it. Have you
especially
thought
with
about this at all?
yeah,
You
yeah.
know?
Like even with like dividend investing, like some people are like, okay, I want to be able to retire off of dividends, or do you want like a revenue stream that can fund your vacations every year for the next
Right, right.
like
Like,
it's
what are your
completely different.
goals?
Yeah, like how you invest in those different things are completely different.
Right, right.
And like you talked about before, like your risk tolerance and like what you want to do. Do you want to be like really aggressive into like REITs, or do you want to be all ETFs,
Mhm.
or do you want to be into higher dividend growth, or whatever it is? So
Yeah, you definitely have to understand, emotions plays a big part in investing, and you have to understand your emotional intelligence and what you're willing to risk and what you're not willing to risk. And like knowing yourself,
mhm,
I think is really important. And I just always felt like, I trust that the market's going to go up over time and
mhm,
not down over time.
yeah,
Now, is time a week, a month, a year? No. Time is over 30 or 40 years, it's going to go up.
mhm,
So I can take the emotion out of it.
yeah,
And I think that that's, some people just don't have that emotional wherewithal to wait out bad periods, or get too excited on good periods.
yeah,
You just have to realize, it's an upward trend over time, and don't look at it if it's going to make you make bad decisions.
mhm,
Like, look at it once a year if you can't handle looking at a monthly statement.
yeah, yeah,
So you have to know yourself. And if you are the kind of person who's going to get too emotional about it and too worried about it, then definitely ETFs are the way to go.
mhm,
Mutual funds are the way to go, and forget about it. But if you're the kind of person who, can see the bigger picture and not make emotional decisions, then okay, then you can start playing with individual stocks, and it's fun.
yeah,
I
yeah. I
really
like it.
enjoy
Yeah, I like
it.
it. Well, and like the thing that's kind of annoying for me is like I realize that the easier thing to do, like everybody is trying, not everybody, a lot of people are probably trying to outperform the market. Like that, like
Yeah.
if not, you just invest in the market. Like that's kind of the thing in there.
Mhm.
But like
it would be way easier for me to just like every time I get money or get paid or whatever, just to add money to the S&P 500 and just not do anything. Like that's way easier, but that's not fun. And I have a YouTube channel. Like I can't be like, oh, here's my monthly recap. I bought 3.26 shares of VOO. That's the end of the video.
Right.
Like that's boring. So, but with that being said, I do basically do that in my Roth IRA. Like my Roth IRA is all ETFs.
I think there's a place for all of it, right? It's like, what is your strategy? What are your goals? And how are you going to get there? And I think that, having a portion of your portfolio tied to the index is prudent, and I think that having a portion not tied to the index is fun. So, and it's not always about beating the S&P. It could be like now that I've shifted into retirement mode. It's not about necessarily beating the S&P. It's about beating inflation. It's about having an income stream. And, where am I going to put that $50,000? You ask me that question and you ask a 20-year-old that question. And the answer is going to be very different.
Yeah, exactly.
So, yeah.
That's just one of my least favorite questions I see. And like I said, I feel like I'm seeing it more and more is on these little groups.
I wonder how much of it are real people versus
who knows? Yeah. Losing battle to try to figure that out.
Yeah, right.
Okay, so the next question is going to be like, what would you say in the course of your investing career? Like, what would you say is your biggest dividend related mistake? And more importantly than the mistake is, what lesson did you learn from making that mistake?
Okay, so I'll put it right out there. It's all over Facebook, right, in the news, but MPW is probably my biggest mistake. And Pfizer, I'm not happy with at all. So those would probably be my two biggest ones. The lesson there is that you need a good exit strategy. And I'll be the first to admit that I didn't have an exit strategy. I'm still working on trying to figure out what my exit strategy is going to be going forward, because I'm sure there's going to be another MPW down the road. Like that was just, it could happen.
I don't want to call it the original one, but like, wasn't Zim the MPW before?
I don't know. I was never in a Zim, and
because that was like during the COVID, that was when all those shipping containers and stuff, and that one's given like a 55% yield. It was really cheap, but the yield was really high, and everybody was in that.
That's a warning sign, right there.
Yeah. There you go.
Yeah, 55%. That's not sustainable.
Yeah.
But so I'd say those are my two biggest, I'll say, disappointments. I don't know if they were mistakes in that. I did my due diligence on both of them, so it's like, okay, I ran them through all of the ropes that I would run any purchase through. And at the time I bought them, things looked good. Things looked safe. Things looked good on the forecast. And then stuff happens. COVID happens, a renter doesn't pay, things like that you can't foresee. And I always, talk about the crystal ball. We don't have a crystal ball, which we did, but we don't. And so you could buy something good and it could end up being bad. So I think back to the fact that it's not a real loss until you sell it, and it's not a real gain until you sell it. So that's where, I might still be in the process of a huge mistake in that I haven't sold it. Neither one. I haven't sold MPW or Pfizer. I keep reading articles. I keep watching YouTube videos. I keep, seeing what different analysts say. I check fast graphs. I look at different things. And I'm like, I don't know. I guess I'm thinking that it could turn around. Like they're like the second largest, REIT for hospitals in the world, right? They're multinational. So, I'm sitting here waiting to see how big of a mistake it's going to be at the end of the day.
Well, the thing and like you said about the crystal ball, that's very true. Cause like the thing that you don't know is like, so any money that you invest in one thing, it's opportunity cost because you're not investing that same money in something else. So like that's another thing. Because in my conversation with Russ, he was talking about AT&T and how he was still hopeful it was going to turn around and stuff like that. And I was like, okay, so in the case that it turns around to the point where you're now positive, even if you did, take your, smack on the wrist and sell it and say, okay, it was a bad decision. Here's why it was a bad decision. Here's what I learned. Let me just move on. Like
Mhm.
the difference is like, okay, what could that money that what could I have taken that from and put it into kind of thing. So like
Right.
that's the other part of the thing is like, okay, not only am I going to hold on and see what
Right.
happens, but what was the alternative? Like for me in the quote unquote positive case would be like with Nvidia. When I sold Nvidia, it went up 24% like 3 days later after hours, which is my luck.
Of course it did.
Yeah, of course it did. Yeah, I literally didn't sell anything for like 2 years. The one time I was like, okay, I evaluated. I was like, okay, it doesn't fit like all my criteria, all my metrics. I'm gonna go ahead and sell it, put it into something that does.
Yeah.
I was up 55% on it, like all the things. But I
Yeah.
put that money into Costco, and Costco since then is like one of my top performing stocks. It's up like 30%. It just gave me a $15 per share special dividend. Like it's doing all these things, and I'm like, okay, like could I have made more money? Like obviously in hindsight, I would have made a lot of money with Nvidia by holding it, but it still wouldn't have fit my metrics, and I would have missed out on what I have from Costco.
Right.
So it's
and that's definitely, something you have to consider. And I think that's part of a sound exit strategy. And that's, I think, the lesson that I'm learning is that I have to have an exit strategy that's flexible enough to allow for, like, if you say, well, if anything goes down 5%, I'm selling it. Well, on a red day, that could be a lot of your
Tesla
stocks.
does that every week.
So that's not a good criteria. Scratch that one. And it's like, well, is it a dollar amount that I'm looking for? If it goes, or a lot of people say, well, if they cut the dividend, I'm out. Well, there's a lot of reasons why people, like a company, will cut a dividend, and it's for a good reason. Like maybe they spun off the company, or they did something, and it's not necessarily because the business is going downhill. So I think you can come up with a framework for how you want to exit, but then every situation, I think, is unique that you have to look at to say, does this fit that framework? And do I want to give it a little bit more time or watch, and so I'm not really sure what my exit strategy is yet, but I'm watching a lot more closely things that are losing money. And I've got like my list of dogs, like these are the ones I'm really watching. And I have some that, I just put in limit orders for sell on. So it's like, hey, if I hit this, I'm getting out. Like, so they're just sitting out there waiting to sell. But those are like smaller losses where something is like more volatile. Like right now, I'm more about keeping a low beta. I'm not aggressive growth, so my strategies have changed. And so I would rather see, I don't want to see big up and down, I want to see steady Eddie now. So it's helped me learn some things. I'm not going to pretend like I'm perfect at it yet, because I'm not. And I just think it's something that you refine over time as you get more experience, right? Because every situation is just a little bit different. Stocks aren't cookie cutter, and you can't say what works for one's going to work for the next one. So
and like the crazy thing is, like somebody that bought Apple at $59 a share and somebody else that buys it at $190 a share, like they have completely different opinions on the same stock.
Absolutely.
It's just, and some people at the end of the day, like I don't think I could have bought Apple at 59. I don't think I was buying stocks when Apple was $59, but like, so it's one of those things. But like to your previous point was like, I don't necessarily care what Apple is today. I need Apple to be big 30 years from now. And another thing
that's the crystal ball thing, right?
Yeah, exactly. So like to me, like if you had to bet, would a company like Apple be non-existent in 30 years? We don't know, but like you can put more chips in the basket of, I would bet not. Like it's the biggest company by market cap in the world. Those things typically don't just disappear. Like that's not how that works.
Right. Well, then you had your blockbusters, right? So you never know.
Well, and like that was like a really good, like looking back at that, like, okay, what did they do wrong? Because they were so big. Like that was a staple for everybody's weekend.
They didn't change with the time.
Yeah, exactly. They weren't able to pivot. They were hard headed. They were like, we're not, like, this is what we do. This is all we're gonna do. And then when they were like, oh, people are always gonna want to come into a place to buy a movie. Like that's not how that works. So like to me, that's a sign. And like some of the companies I own, like Apple and Microsoft and Visa and Costco and those, like they show over time that no matter what comes up, whether it was COVID or whatever happens, they're able to pivot even though it is different a little bit or a lot of it different than what they're currently doing, they're still able to say, okay, things are changing. We need to change with the times. And that's what successful companies do. So,
yeah.
But anyway, like I said, you said nobody knows for sure. It's just like investing is kind of like gambling, but like educated guess gambling, like things that you don't really, you have a little bit of control. Like at the end of the day, like I have an iPhone, so I'm supporting it. Where when I go to the casino, I have literally no control over. I mean, I guess I control like whether I max bet or don't max bet. I guess that's as much control as you have. But
I don't know. I don't think investing is gambling, and I just disagree with that when people say that, because it's I think the bigger gamble is not investing.
Yeah, true.
That's the bigger gamble, because you're gambling that, somehow you're going to be able to support yourself when you're no longer want to work or able to work as you get older. And, putting your money under the mattress or in, a savings account is not going to get you there. That's a huge gamble, a huge opportunity lost. So, if you have a diverse portfolio and you have, you're doing your due diligence, I don't really consider that a gamble. I consider it like you have to look at the whole portfolio, right? Over time. And that's going to always go up.
Yeah.
So,
well, and so coming from being a saver versus an investor, like I've been investing for almost 4 years now, but like when I was a saver, my thing was I was so afraid to lose money more than I was excited to make money. So like, that's the thing is like when you put money in if I put 10K in a savings account, I'm gonna have 10K in a savings account tomorrow. But the same thing that makes that appealing is also the thing that ends up ruining you. Cause you're gonna have 10K in that savings account tomorrow. That's never gonna go to 11K.
It's not gonna be worth 10K anymore.
Yeah, exactly. Yeah, and like that's just like general like finance knowledge that people don't have. Is like people when they hear inflation, they just think, oh, when I go to the store, milk costs more. But like they don't understand like the nuances of that. Is like, okay, that means that same dollar you used to use for this, you now need 2 of those.
Right.
And like that's what like people don't ever connect those two. They're just like, oh, gas is more expensive, eggs cost more, whatever. But like the actual like breaking it down and understanding what that actually means is that you need to make twice as much money to get the same thing.
Right. Well, I think that there's a place for savings and a place for investing. I don't think it has to be an either or.
Yeah.
Like the whole time that I was, for decades, I had different savings accounts, one for Christmas, one for vacations, one for cars, one for, I don't know. I had like 4 or 5 different accounts that I had very specific things short-term that I was saving for. And I think when it's short-term, you don't put your money in the stock market. When it's short-term, you put it in a high yield savings account or, a CD or something like that, right? A money market account, something like that. So that it's liquid and you have it right away.
Yep.
And when Christmas would come, the bill would come in, I write out the check, it's done. Like you budget for those things and you never have to worry about it. I think having a good budget and good short-term savings allows you to invest because then you know what your extra money is you're working with. And you're not hit with these, oh, now I have a car repair. Oh, now it's Christmas. Oh, now it's a vacation, so now I can't invest because
people always wait for the perfect
I would have
time.
invested for a short-term thing. Like they're mixing up their short-term money and their long-term money. So I think like the first thing people have to do if you want to start investing is get your short-term world in order. Understand what your budget is. Budget for those short-term things that you need. Identify then what your discretionary money is so that you can take that and start dollar cost averaging into whatever it is, like you want to do it. But, then, okay, Christmas isn't going to interrupt my investing plan. Vacation isn't going to interrupt my investing plan. But if you don't have those short-term things and even like an emergency fund, depending on if you're single or married, 3-6 months of cash on hand, get that set up. Once you get your short-term world in order, then you can start investing, right? Get your credit cards paid off. Get that done first. Don't be paying anybody 25% interest on a credit card. That's insane.
Yeah.
Pay cash, pay that thing off every month. If you can't pay that thing off every month, work on that first.
Yeah.
Right. So I think like your personal finance, you have to get a grip on that in order to be able to know, okay, I really do have $25 of discretionary money a month that I can put into the stock market, or I have $250 a month or $2,000 a month, whatever it is. You're confident you have that because your personal finance is taken care of.
Yeah. When so many people, they like what you were saying before, when you started with $25, so many people are like, that's such a small amount of money, it won't matter, but it's better than not.
It's the discipline.
Yeah.
It's you're disciplining yourself. You're getting habits over time that are good habits. And then, you get a raise and now you're doing $35 a month.
Yep.
Then you get a raise and you're doing $50 a month, or you get a windfall and you're like, oh, I got this extra money from whatever. I'm going to put it here instead of spend it.
Yeah.
Right. And so because my spending is under control because I have a budget and I have my personal finance wrapped up. So if I get a windfall, I don't need it to pay a bill. I can stick it in investing.
Yeah.
And so, I think it's just creating those habits in the mindset. Like even if it's $25 a month, it starts shifting your mindset from savings to investing. It starts building that emotional grit that you need to have to be consistent and weather the storms.
Yep. I agree with that.
Well,
Yeah.
I think it's just,
Yeah, I mean, like you said, it's like then you start asking yourself, okay, I don't think 25 is enough. I'm still gonna invest it anyway. How can what do I think is enough, and how can I get there? Like whether it's like, oh, okay, like do I need 8 streaming services? Maybe I only need 3. Oh, okay, that's gonna save me $60 a month. Now you can add that. Now you're at $85 a month, and like any extra money, instead of like a lot of people, what they do is like they spend their paychecks before they earn it. And that's one of the issues is like their expenses or what they want to do or what they think they need versus what they want. They have all that stuff so mixed up that when they just don't like that's why I was asking the question about like when you started thinking about retiring in your 20s, that's not normal. A lot of people are like, oh, okay, I just hit 50 years old. Now it's time to start planning for that. And while it's not too late, you're certainly making it a lot harder than it had to be.
Yeah, and it's never too late to start, but outcome is going to be very different, and you got to go into it knowing that. So there's that. I think it's the mindset of I'm going to buy a $4 Starbucks coffee every day versus make my coffee at home and invest $4 a day.
Yeah.
Right. So those are the choices that people make, and the choices you make matter. The decisions you make matter. And it's going to affect the bottom line at the end.
Yeah.
So it's like, we live in a world of instant gratification, and it goes back to that emotional stability of being able to, not worry about the instant gratification and just have your goals set, understand what your goals are, understand how you're going to get there, and then execute on that plan. So think about it before you do it.
So what are your thoughts on, 'cause I just had this conversation the other day. What are your thoughts on people that say that they don't want to necessarily invest because they want to live their life now? Like they don't want to just save up the whole, like for my goal is to get to 50 years old and be able to retire off my dividend portfolio. Like that's my goal. And some people will look at that and say, wow, like you don't get to like enjoy here and now. You don't get to enjoy and I would argue with that. Cause like I have season tickets to the Thunder. Like I've been to like 230 games in a row. Like I've done all those things. And I just, to me, I would like the only thing, whether you're rich or you're broke, the only thing you can't buy is time. So like, I would much rather limit how much quote unquote things I like need to do today to be able to do whatever I want, whenever I want, forever once I hit my goal. So like, what are your thoughts on that?
Yeah, I think that the person saying that it's kind of like that sucker's choice, if you've ever heard of that, where it's like, I'm not going to pick one of those. I'm going to do both. Like you don't have to give up living your life now to invest for your future. If your personal finance isn't in order, maybe you have to.
Yeah.
But that's why I said you got to get your personal finance in order first. So if you don't know about personal finance, read a book on that first. get your personal finance in order, get your budget in order. You know, I went on vacations. You know, I didn't fly to Europe every year. Maybe I went to Myrtle Beach with the kids, right? That would take the family to Myrtle Beach, or took the family, you know, to somewhere where we could drive or whatever. But would certainly say we lived our lives. You know, you don't stop living because you start investing.
Yeah.
So I think those are like, it's the wrong question. I think the right thing is how can I do both?
Yeah.
And you can do both. And if you find that you can't, then it's probably because your personal finance is not in order.
Yeah.
You got to start there. And then if you're like, well, okay, well, I don't make enough money for my personal finance. Okay, well, then you need to go invest in yourself. What new skills do you need? Do you need to change your job? Do you need to, you know, like you have to invest in yourself and educate yourself. And if you don't have enough money to do both, then invest in yourself, build up your skills, get a better job so you can do both.
Yeah. Yeah. I agree with that. It's like, some people don't think like what you're saying, where you would, you know, drive to the Myrtle Beach or whatever it might be. Like maybe like that's okay enough for like me and you. Like you're still getting to have the experience. You're still getting to have a vacation, stuff like that. But like, it's not extreme enough for somebody else to feel like they're quote unquote living. And I'm like, okay, well, like that's more of a mirror thing.
Their choice. Then they don't want to live. Then maybe they made their choice, and they're going to have to deal with that when they're 65.
Yeah.
And then they can live off of Social Security, and we can go have that conversation with them again and say, okay, was it worth it?
Yeah, exactly.
Like, do you remember that vacation 40 years ago now that you can't pay your electric bill?
Exactly.
Like, you know, and that's where you have to, that's the instant gratification mindset that to me is, it's somewhat immature and somewhat uneducated. Like, you have to have that, again, some maturity, some ability to look down the road and not worry about instant gratification. But again, like I said, our family lived our lives, but we did both. And a lot of it, again, is get your personal finance world in order. And then you take your discretionary money on top of that and go invest it. Right? Don't be paying credit card interest. Don't be paying big, huge, like, interest on getting, you know, car loans. You buy a $50,000 car and tell me you can't invest. I want to tell you got your priorities screwed up.
Yeah.
You know, and I mean, that's in my world, you have your priorities screwed up. If that's what you want to do in your world, that's fine.
Yeah.
But don't cry when you're 65 and you can't pay the bills.
Yeah. Well, that's, I've said this for, I feel like a decade now. Like, I think it would be so cool. Like, they have all this, like, I don't know what the difference between like VR and AR is. Like, to me, it's the same thing. But anyway, they have all these different like alternate reality, virtual reality kind of stuff. I think the coolest use for that would be like it's almost like a life simulation. By making this choice, this is what happened. And it could quite literally be simple stuff. By, hey, oh, I want to have one cheat meal a week. Like, that's my thing. Or I want one, you know, whether it's breakfast, lunch, or dinner. I don't track that as much. And I really, really do really good for these meals, but not so much this one. Like, okay, fast forward 30 years. What does that do? Like, whether it's the lessons or the, not even the lessons, but like the discipline that you do or don't get from making those decisions. Same thing with what you're talking about. Like, okay, $50,000 car. We're going to, you know, extrapolate all this stuff out, and this is what that turns into. Like, is that what you want? And like, since there's nothing like that, and I've never been 50 before, and whoever else never has been something else in their future before, it's hard to, like, that's one thing that is really hard about being 20 or 30 or whatever and planning for retirement, is you're planning for 30 years from now.
But you can do that. There's all kinds of tools out there. So you could go to your broker, you know, like I use Fidelity. So like you can go in there and there's a retirement planner and you can play with the numbers, and even probably online, if you know, do a search for retirement calculators or things like that, you can play out different scenarios. Well, if I save this amount of money a month versus this amount of money a month versus this amount of money a month, right? Here are the different outcomes, and they'll extrapolate that all the way out until you're 90 years old, until you can put what age you feel you're going to die, which is it's the morbid part of this whole thing, right? Is like at the end, you're dead.
Yeah.
So you have to say, okay, how long do you think you're going to live based on family history and whatnot? And it will calculate that for you. And you could say, okay, if I took that extra $20 for that meal that I wasn't going to have every week at a restaurant and put it instead in the investing, what would I have later on? And I think that's one of the things that really kept me disciplined and motivated through all these years, is that every year at Christmas break, when I was off of work, I would do an analysis of, okay, here's everything I have. Here's still what my goal is. Am I on track to meet that, or am I not on track to meet that? And I would use calculators and formulas and whatnot to figure out. And like I said, these things are available. Tools are available. Go to your broker. I'm sure they have a tool there if you can't find one anywhere else. And plug those numbers in, plug in what your expenses are, plug in what your income is, plug in how much your savings, and it'll tell you the difference. So when you look and it says, when you retire, you're going to have $450,000. But if you change those numbers, you're going to have 2.5 million. That's a motivator to change your behavior today. Right?
Yep.
So that's, you can kind of do that.
Yeah. Yeah. I think with the AR or VR, it'd just be cool to like see it like visually, like know, like, hey, here I am in my 67-year-old body, and like, oh, I'm just living off of Social Security, and I can't do this thing because I made those decisions. Like that would be, it'd be cool to see the cause and effect. Cause like you're talking about with like instant gratification, we also don't get like the instant, repercussions of decisions we make either. Like in most cases, like it's not like, hey, I did this thing, oh crap, here's the consequence. Like most things we do aren't like that. It's like, oh, I did this thing 5 years later, here's the consequence. And a lot of times, and so that's why I asked that question that way, was like the biggest mistake you made, and more importantly than the mistake is the lesson learned. People never tie it back to the reason that they are where they are, whether that's good or bad, was based on a decision that they made some amount of months or years ago. They never do that. They never sit back and reflect, like, okay, why am I in this position? What, like, whether it was something good I did or whether it was something I didn't do perfect, like that's what put me here. And nobody reflects on that. That's
why like an annual review is really, I feel, something that like was very motivating to me and kept me on track, because I could say, oh, I'm doing this annual review and it looks like, for whatever reason, like I didn't always know what the reason was, but for whatever reason, I'm not on track to meet my goal anymore. Okay, well, let's see. If I plug in the number and put this much more in a month now, am I back on track? Yep, you're back on track again. Okay, go into the 401k, increase it by 1 or 2%. Let that run out for a year, check in again. How am I doing? Oh yeah, I'm on track. Just keep doing what you're doing. Or, oh, yep, you're falling a little short again. Go ahead and add a little extra. A couple times I remember going in and doing the exercise and saying, oh, I had more than what I thought I needed. And I was like, oh, that's interesting. I'm going to reduce how much I'm putting in my 401k, increase how much I'm putting in my kids' college savings, because that's a more immediate need, so it's not always telling you have to put more in for retirement. A couple of times it told me I was oversaving, and I was like, oh, okay, I was too aggressive there. Let me cut back a little bit and take care of this immediate need and then come back to that, because I put 2 kids through college at the same time. So I was, I had short-term and long-term goals, and you have to kind of balance those against each other. But, you just have to remember that kids can get college loans. You can't get a loan to fund your retirement. Yeah. So although most people want to help their kids and help pay for college for their kids, don't do it at the expense of saving for your retirement, so do it in addition to.
Yeah. I mean, that's a really good segue. So the next question is like, what are some of your short-term goals? Like, let's just say for 2024, what goals do you have with your portfolio, your dividends, like stuff like that? And then like, what are some of your longer-term goals? Like, what do you still hope to accomplish with your portfolio?
Yeah. Well, short-term, we're going through a transition. I've only been retired for 2 weeks. So, so short-term is, it's more tactical. I'm going to be rolling over my 401k into the traditional IRA. I'm going to be doing some Roth conversions to get that money. I have some money in Roth, but most of my money is in traditional. So I'm going to be doing some conversions over the next 3 years. I've been working with an income tax specialist to like really hone in on exactly how much to convert every year so I don't get a huge tax bill. Yes, there's going to be a tax bill, but to make sure that it doesn't like bump me up too high of a bracket. And so I think like when you get closer to retirement, seeking help from professionals where you don't have the expertise is really, really important. I am not a tax person. I mean, yep, I can file taxes and things like that, but I don't know all the ins and outs. And so that's been extremely helpful for me talking to somebody else and getting advice about stuff like that. So short term, it's more tactical, like getting that money moved over there. I have, making sure that I had at least 3 to 5 years in cash so that I wouldn't have to worry about market volatility. Those were short-term goals, but I'm working through all of those types of things. Right now, next week, I'll start the process to get my HSA moved over to Fidelity. So like, there's a lot of tactical things you have to do to kind of like get everything organized and together when you're retired, because it's all over the place, right? With your employers and things like that. So short term, that's kind of what my goals are. Long term is just, to live my best life, like, beat inflation, have that income stream go higher and higher every year. We have our expenses covered with our dividend payments now. So, that was the goal, right? So that was the big goal, not including Social Security, not including any of that. So that'll just be icing on the cake, which is a huge blessing. Like, I can't say enough, like, to be able to be in a position where if it went away, I don't care. Like that's what I planned for my whole life. So that's just a huge blessing to be able to say that. And it's not lost on me at all. So my husband turned 65 and we didn't start collecting Social Security, and we're not going to. We're going to wait.
You have to collect it at 72, right?
There is an age by which you have to start collecting it, I believe, but it's not 65.
Yeah.
And so we're waiting, and that's going to allow us to do some Roth conversions, because you want to keep your income low while you're doing Roth conversions so that they're taxed at a lower rate.
Yeah.
So like, again, just another piece of advice for younger folks. If you have the option of putting money into a Roth, because I know that there's income limitations where if you go over a certain limitation, single or married, you can't contribute to a Roth. But if you have that ability to add to a Roth, definitely do that. So
yeah,
now I'm on the other end converting stuff and having to pay the taxes on it.
Yeah, I did that with the job I was in. So I moved to Oklahoma in 2016. So from 2016 to 2022, I had the same position. And I was putting money in the 401k there. I really didn't know anything about it. I remember going over, I used to call them my gym parents. I met them when I was in Oklahoma at the gym. And I remember going over to their house. And I was like, hey, here's my 401k stuff. Here's my options. Like, I don't know what none of this stuff means. And they were talking to me about like small and mid and large cap. And I was like, guys, I don't know what you're talking. And it's so weird that like fast forward a couple years and I have a YouTube channel where I know all that stuff. It's just like things I've learned over time. And I had to do, when I left that job, it was like, they gave me like a couple options, like leave it there and pay the fee that comes through. I think it was like $9.95. It was either a month or a quarter, like management fees and stuff like that. And I was like, I'm not doing that. So I did the same thing. I think I took money off the top, paid the taxes on it, just transitioned it into a Roth. And I mean, so when I show my Roth on the portfolio updates, people are like, you've only been doing a Roth for so long. How do you have that much money in there? I'm like, well, I did a conversion. So, and it's one of those things like people, it's always the question of like, would you rather pay your taxes now or pay your, they're not going to avoid them. So which one would you rather do? So, yeah, it's one of those things. So I am glad that I did that. And then I obviously have my tax. So it's cool to hear your story, because you sound like you did what I'm trying to do. as far as like, I have my taxable brokerage. My
Yep.
goal is at 50. I want to retire the wife. I want to have 110% of our expenses. And what we do is we are including what we save and what we invest every month as part of our expenses. So if we can get to 110% of that in that account generated by dividends, then we're good. Like that's when we're good, because from 50 to 59 and a half, we're going to be able to live off of that account and still grow that account because we're still investing. 59 and a half, we get our access to our retirement accounts, our 401ks, HSAs, Roth IRAs, stuff like that. And then at whatever age we need to draw from Social Security, we'll do that. So I call it like the horseman approach, where like, no, I was good with this first horse, and then here comes my other horses, and then here comes my last horse. So it's one of those things. And like you said, it like, obviously the retirement stuff will be there. Like that's my money, but whether Social Security is or isn't, I don't know. But like you said, I don't necessarily care because I don't need it.
Right. That's where you're like, you hit that financial freedom, right? It's like, you're not, you don't have to worry about it anymore. And so you mentioned a couple things though that I'd like to go back and hit on, which is one is like having a taxable brokerage account where it's not a sheltered account. I think that's really important for people to do. And I ended up doing that. I started one maybe about 5 or 6 years ago. That was my first time I did that. And I had no idea how big of a role it would play in the retirement process when I did it. I did it to learn how to sell and buy stocks and make decisions and like do things outside of the mutual funds, outside of the 401ks and things like that, and just get familiar with, investing on my own. And it ends up being like, that's the account that is the best account to drain down first when you go into retirement, is your taxable brokerage account. You want to leave your sheltered accounts alone as long as you can because they're growing tax-free, right? So you want to leave those sit there as long as they can. And with people doing Roth conversions like I am, you can pay the taxes out of that taxable brokerage account, and you don't have to worry about a tax event happening, because it's after tax money already. Yeah. So, and then like, if you need 3 to 5 years of cash, that's where you go and get it from. Yeah. That way you don't have to cash in your stocks and in your retirement accounts. So it's good. Like when we talk about looking at the portfolio, you're looking at your whole portfolio, not just my traditional accounts or my Roth account or my 401k or my, my sheltered account. Look at all of them together, and each of them serves a purpose. And I literally stumbled into doing it 5 years ago and did not have any idea how important it would be. When I got to this point, my income tax advisor told me, it's a really good thing that you did this. Yeah. Yeah. Did you know that this was a good thing to do? And I'm like, no, I did it just as an experiment. I did it to learn. I thought, I'm going to just add $100 here, $1,000 there, like just to get used to buying and selling stocks myself, making decision, doing research, getting my feet wet. And it ended up, I would put all my discretionary money after everything else went into this account, and it grew and grew and grew to the point where now it's playing a huge role in my ability to retire and do Roth conversions. So that's a little nugget I didn't know about, and I kind of just fell into properly.
Yeah. Well, I mean, and you did fall into it, but it was also like, due to the education you did have in other areas, like that's what helped you be able to fall into that. Cause like a lot of people were just like, oh, she got lucky with that decision. Like, no, you had other education in other areas that are related, which caused you to, like, if you would never invest, you would never know there was a difference between a taxable brokerage account and not a taxable, like you wouldn't know. So like, it is kudos to you still for like having the knowledge and putting yourself in the situation to make a good or bad decision by doing that, whether it's on accident or on purpose. Like that's
another little nugget that I learned, and I learned this from a friend one day over lunch, was there's a thing, and not every company offers this. So you have to ask your company and find out about your plan. But in your 401k, like at Fidelity, you can open a brokerage link account that's linked to your 401k. And you could sell mutual funds and move that cash to your brokerage link account. and you can buy individual stocks in there. And I never knew that you could do that. And my company offered that. And so that's another thing that I did. I started to sell mutual funds when they would hit like a 52-week high. I'd sell not the whole thing, but I'd sell a portion of it, and I'd move it into the brokerage link account. And that would give me more practice on buying stocks, researching stocks, and I'd start buying. And that's when I really started getting into dividend investing, because there was a turning point where I like really turned the dial up on dividend investing and down on aggressive growth.
So what did that process look like as far as like the switch from the aggressive growth? Like, were you only in growth stocks that didn't pay dividends, or were you in some like, what they call dividend growth stocks, and then you transitioned into like more higher yields, or like how'd that work?
Yeah, this is a kind of an interesting, funny story, but I was always aggressive growth. So I would put my money in whatever was making the most money, like in that, what the employer gave you. Like, I don't like targeted funds, like targeted year funds.
Yeah. Target date funds.
Yeah. I don't care for those. They just don't have great returns. I don't dabble in bonds at all. I'm 100% stock. And I know that goes against traditional wisdom of, well, you should have 60% stock, 40% bonds.
Yeah.
It's
my money. If I want to spend it, I'll spend it.
Yeah. Yeah, forget that. No bonds for me. So anyway, I was plodding along, putting my money into the mutual funds in my 401k. And I use Quicken for my personal accounting at home. And I was just like playing around in Quicken one day, and I went to the reports tab. And I'm like, oh, there's a reports thing here that says income report. I go, I wonder what that is. And I clicked on it, and I drilled into it. And I'm like, oh, I was making like 30 grand a year on dividend income, and I didn't know it.
Did you know what dividends were?
I knew what dividends were. I knew the definition of dividends. I knew what they were, but I never looked at them. I never tracked them. I never cared about them. I always, at the end of the year, when I would do that evaluation, my thing was, do I have more this year than I had last year? Like, what's my net worth this year versus last year? And am I on track for my goal? That's what I was looking at, bottom line numbers. I wasn't looking at the components of how much of it was capital gains, how much of it was dividends, and all of this, how much of it was interest. I wasn't looking at that at all. And with a mutual fund, I don't know what would make you think about it, because most people, they'll put their money in their 401k and they really don't even know what's in that mutual fund. Like, they don't even know what stocks are being held in that fund. They just know this is the name of the fund. I'm putting my money here. Right. So I wasn't that sophisticated to even break it down and know. I'm sure it was a line item on a 17-page Fidelity quarterly printout, right?
Yeah.
But it wasn't what I was honing in on. I was honing in on that bottom line. And so when I ran that report that day and I saw like I was making 30 grand in dividends, I'm like, where am I making, how am I doing this?
30K on accident. That's pretty good. Yeah.
I had to reverse engineer it. I had to go back and look at, where are these dividend payments coming from? And I found like some of the mutual funds, like the stocks within those mutual funds, paid dividends. So those mutual funds were paying the dividends, and I was like, that's more than some people make a year. Yeah. Like, that was like a turning point for me that said, if I could now turn my mindset to focusing on dividends, what could I do? Yeah. If I can make $30,000 and not even know it, what could I do if I focus on it?
Yeah.
And so that's when I started opening up a brokerage account, and I'm going to start really focusing on dividend investing. And I think it's called the Single Best Investment was recommended to me. I think that's the name of the book. I don't quote me, but if you look it up, I think it's one of the books a lot of dividend investors read. I think it's called the Single Best Investment. It's all about dividend investing. And so I just read that book like 2 times, and then opened up the taxable brokerage account and started Dominion, I think was my first stock I bought. which I later sold. But that was the first stock that I think I bought was Dominion, and probably like Verizon or something like that, just to go through the motions and start playing with it. It was all like a sandbox for me to learn, but then that's when my focus really shifted towards, I'm getting closer to retirement. I want an income stream. I want to replace not necessarily my income, but I want to be able to cover my expenses in retirement. And that's when I really, focused in on having goals around how much dividends per month do I want to get, and or per year, per month. And then looking at, okay, well, the way I have my money invested today, I'm not going to get there. Like, I got to make some changes in my strategy. Again, this is talking about what are your goals and what are your strategies, and how do you have to adapt to meet that goal. And so then I just start breaking out Excel spreadsheets and like, okay, well, what percentage of my money would I need to have making 3%, making 4%, making 5%, dividends? And what would that give me? And how could I come up with this amount of money? Like, my lofty goal was, I want to make $100,000 a year in dividends. Like, I wasn't even thinking about expenses 6 years ago. I was just thinking about, what do I want to make in dividends? And I thought, well, that's a goal I'll probably never achieve. So let's shoot for it. Right. I'm already at 30. How much harder can it be to make? And I didn't even know that. Right. So it was like, I felt kind of stupid in a way, but it was like, it really wasn't my focus. I wasn't thinking about dividends at all. So then I just started playing around and realized, all I need to do is reposition this money into things that will produce the amount of dividend payments I need to meet that goal. So I just started slowly shifting money. And it's not something like you log in and do in one night. I'm talking like, this has probably taken me a good part of the last 4 or 5 years of slowly shifting money into income versus growth. But at the end of the day, my strategy is to have keep about 15% in growth. So I have the Apple and the Microsoft and the Broadcom, I have that. And the Costco's and, the things that are paying low dividends, but you would consider more growth stocks. But I try to keep that around 15% of the portfolio. And then I think 50% of the portfolio, I do growth and income. So stuff that's paying 2% dividend to 4% dividend. That's where the major chunk of it is, where you get your steady eddies in there. They're paying you a good dividend, and their dividend growth is you're growing your dividend. And then I've got probably the remaining percent is in pure income. So stuff over 4%.
Okay.
And I have a UTG, a SEF. Utility stuff that I don't know if it's pays 8-9% or something like that, where you get your higher paying stuff. So, and then that's kind of that mix is the right mix that put me over $100,000, right? I overshot my mark, which,
that's good, because that was a goal you didn't think you'd get.
Yeah, right. Exactly. Always set a goal beyond what you think you can do and figure out how you can get there, and, then execute on the plan. You have to have the discipline to execute on the plan.
So,
but it takes time.
So your segues are really good. So the next question I wanted to ask is what dividend milestones, which you just talked about, the 100,000, what dividend milestones or achievements have you recently achieved, or are you getting close to achieving? And because dividend investing or investing in general is such a long game, what role do those play in keeping you motivated to make sure you're actually hitting those goals year after year or month after month or whatever it is?
Right. Well, again, numbers just fascinate me. So I just enjoy, playing with the numbers. But that first milestone was knowing that I was even getting a dividend income. And I remember going to my husband, I says, do you know that we're investing 30 grand a year that we're not working for? I just found this out.
Did he say, yeah, duh? Or
he was even more dumbfounded than I was.
Wow.
He was like, you got to be kidding me. And I'm like, no. And we were both and again, I was really focused on what the bottom line was net worth year over year, and not what went into making that. Dividend investing wasn't even in my vocabulary. I knew what a dividend was. That was the end of it. But I didn't know there was like a discipline called dividend investing, because I only knew mutual funds. I only knew my 401k, and that's where a lot of people live. That's what they know. I think people that buy individual stocks and do dividend investing are probably the minority of the population.
Yeah.
So, most people would be in that same position and not realize they're getting an income stream from these mutual funds.
And if passive income stream.
Yeah, passive income stream.
Yeah.
And if they're not using Quicken reports, or if they're not going through their annual or quarterly reports with a fine-tooth comb and then adding that up, to really realize it, they're not even knowing that they have it.
Yeah. Well, I mean, but I found, I found that in my experience of like talking to people, when I was in the office, I'd talk to people about like their 401k, and you always hear the same stuff like, I'm hearing bad news about the markets. I'm thinking about, getting my money out of there or whatever. And I'd always like, obviously not financial advice, but like, hey, that this is the best time. Like you're going to get the same stuff for cheaper, like all kinds of stuff, but whatever. It's their money. Do whatever you want. But, and it was one of those things where like, it's just I found that assuming people know basically anything about finance is that's not a good strategy. Like, like when you say about like dividend investing, like to me or anybody that watches the channel, people are like, oh, how did you not know about dividend investing? Like, that's wild. This is our thing. Like I'm dividend obsessed. Like that's my thing. But like, and then there's other stuff that like, I think it was 2 weeks ago, I talked to Steve, and Steve does closed end funds. And like to him, that's like, back, like he just knows that stuff. And like to me, I'm just like, that's a whole, I know what it does kind of, but like I don't really know. So and the point of me saying that is like, it's so hard to assume that somebody knows like something that you are quote unquote an expert in, somebody else has never heard of before.
Exactly. And that's why like when people ask these general questions on Facebook, it's just like there's so many specifics that are missing and so much nuance to it that you can't even answer those kinds of questions.
Yeah.
But I mean, like I've read Steve's book. I think I got 75% through it. I haven't finished it totally. Yep. I've got it. It's sitting over there. But like UTG, I think is right now my only closed end fund that I have. It's a utilities SEF. And I like it. I like it. It's doing what I want it to do. Is it beating the S&P 500? No. Do I care? No. That's not my goal.
So that one would be in your whatever you said, like 15% is the 8% and higher. Like that one falls in
that would
one?
be part of that.
Okay.
Yeah, that would be part of that.
Now, do you see like over like let's just say the next 5 years, do you see your percentages changing, or did you run the numbers to keep those percentages where they are? As far as like, you said you have 50%.
How much is in each bucket?
Yeah.
I don't see them changing because the way I have them seems to play all the way out until 90 some years old. So I'm fine with it. But that doesn't mean I won't change them because I'm constantly reviewing, right? At the end of every year, review what you have. Am I still on track? I mean, the big thing was, do you have enough? And I think one of the questions that you sent me in advance is when do you know enough is enough, right? And it's like, okay, well, you have to understand what's your lifestyle going to be like in retirement? What are your expectations? What are your bills going to be? And until you sit down and really figure out what your expenses are going to be in retirement, you don't know when enough is enough. So just like I said, personal finance is really important before you start investing. Get your personal finance world in order. Understanding what that personal finance world looks like in retirement is really important because that helps you set what your goal is. And, there's different theories of figure out what you think you're going to need and then add 20% and then that's enough. You want that buffer, right? So I went to Fidelity with a detailed list of every expense. I went through, before I made the decision to retire. And I knew I was making the decision. Like, is it this year? Is it next year? Is it the year after that? I knew I was getting in that window where I was getting close. And I'm 59, so I retired early. But I knew I was getting close with the grandkids all being born and my husband's already retired. It was like, I was in that zone, right? I just didn't know exactly when. So I started sitting down and I went back through 2 years worth of credit cards, Venmo, PayPal, checking account, every single thing that I paid out for 2 years, I categorized. I'm a very detail oriented person. I'm a planner. So maybe this isn't everybody's bag and they won't do it. But this is how you know if you're going to have enough, is by understanding how much are you spending in all these areas of your life. What is your budget going to look like? And then thinking about then going out and pricing, what's it going to cost for me to retire without health insurance?
Yeah.
I'm going to have to buy health insurance. How much is that going to cost? I'm going to, different things like that. Vision, dental, whatever other insurance you want to buy, you got to think about that. You've got to pay your, taxes on this money that you're getting in, right? So you got to account for taxes. There might be other expenses like, deductibles and copays and stuff like that. That's on top of your premiums. So you want to think about what are the expenses going to be when I retire that I don't have now, but then there's also expenses that you're not going to have in retirement. Like if you have children, you're saving for college. You're not going to need to do that anymore. So you don't put that in there as an expense when you're retired, things that you're not going to need now.
Well, and a lot of people have like one of their biggest expenses is their mortgage. And if you play your cards right, you may or may not have a paid off house. And one of your biggest expenses, your biggest expense is gone.
Yeah, pay that off. And some people are like, hey, I'm fine having a mortgage in retirement. And I'm like, okay, good for you. I'm happy for you. You're fine with that. I am not fine with that. My husband was not fine with that. We got our house paid off. We were making triple payments. Like we made an effort to pay the house off, a big effort. And, did we have a low interest rate? Yeah, we did. And some people would say, well, you could have made more money in the market. Well, okay, good. That's good for you.
Yeah.
But for us and how we felt, what was our risk tolerance? Like I said, know thyself, right? What are we going to be happy with? We wanted to not have to worry about it. So it was worth it to us to pay it off. So that's definitely something. But like get with your broker. They have all kinds of retirement calculators where you could go in and put in what those expenses are going to be, put in what your anticipated income is going to be, and figure out what is enough, and if you have shortfalls, then oh, okay, I'm going to put an extra $20 or an extra $200 or whatever it is that you can put towards it. And then that way, when you get your goal is 50, when you get to 50, you say, okay, now can I do this? Because you've got to cover 15 years of medical expenses without an employer, right? So that's something to really think about.
Yeah, and that's going to be one of the things too, is like, it's just some of those expenses are like, that's where like conversations like this are really helpful for me and maybe anybody else that might be in my situation, is like, there's certain things that like you're going through that I haven't gone through yet, but I can talk to you and like, oh, okay, like that's something good. To, like I've definitely heard that like one of your biggest expenses in early retirement is health insurance. And like, that's, I do expect that. So I'm like, okay, by the time I'm 50, I want to have any cars that we have, like those should be paid off. The house that we're in should be paid off. And I'm hoping that the money that we were counting on spending on either or both of them would be enough to do the health insurance. And like I said, technically right now we're saving for the house. So when I say I want 110% of savings and investing along with my expenses, in theory, I should still be quote unquote saving money, but that savings is just going to keep going towards the investing. Cause like, we're not going to be able to save, we're not going to need to save for a house because we're in the house that we would be saving for. So like, that's kind of like how, because my very first interview was with Chad and he was the one that came up with the 110% thing. And he was just saying it's more than you need because it's 110%. And it's also including the money that you aren't, like most people, what they do is they want 110% of their expenses. I'm like, okay, well that's fine. But what if expenses go up, or what if there's an expense that you weren't counting on or whatever? So if I'm doing 110% of expenses, including money that I don't necessarily need to spend or need to save or need to invest or whatever, it'll keep my portfolio growing and I get to also have more than enough kind of thing. So like that's,
yeah, I think however you figure it, if you add 10, 20% to it, you have that buffer there. That's good. And you got to remember, like, you're starting to withdraw that money at 50, you're going to start pulling out. Right.
Well, and the goal would be that I'm like, say my portfolio is making, I don't know, $7,000 a month, whatever it would come out to. Let's just say 10 grand a month, 10 grand a month. If our expenses only come out to 6,000, I'm not going to pull out 10 grand because I don't have to.
Right. Exactly. But you have less money in there making money. Okay? When you start pulling out money, you have less money making money. Right. So that's where these calculators that you can use, retirement calculators, can show, okay, I'm going to start drawing down at age 50 or 55 or 60 or whatever age you're going to start drawing down. And then you're going to see, the growth of the portfolio is going to start. And your goal is at the end, right, that either you have, your beneficiaries are going to get a nice inheritance. Okay. Or you're the one who wants to end with zero. So there's like two ways of looking at that. Like, how do you want that story to end? If you're planning on generational wealth, you want that money to keep growing, right? And to give it to your children or your grandchildren. And other people are like, die with zero, right? I think there's a book out there about that. Like, we're using every penny of it up. How do I do that? So you have to understand, like, what's your end game, right? How do you want it to be over when you pass on?
Yeah. Well, I think the hardest part about
another consideration.
Yeah. The hardest part about that prediction is like, you're guessing when the clock's over.
Right.
And like, you could be like,
I'm only part of the planning is like, well, when do you plan on dying? Well,
I don't know. Like 82 sounds pretty good to me. Then you live to 95. You're like, why wasn't planning for these extra 13 years? Like, I don't know.
Right. Well, that's exactly why, like, Fidelity will, they'll go out to like 92, 93, 94. And then they run all different kinds of scenarios, like worst case scenario, best case scenario, with the market's going to be returning. And you always do, like, in the worst possible case scenario, and I am living to 100 years old, right? Will I have enough?
Yeah.
And if that comes clean, you're good.
Yeah.
Unless
you live to 110.
then you're
like,
at that
crap.
point, you're probably not going to care one way or the other, because you're not at 110. You're not planning worldwide European tours anymore, right?
Yeah.
Like your expenses, kind of your day-to-day things go down, right? Your expenses.
Yeah.
Now, you may be in a nursing home. You may be, there may be other expenses. So that's why, like, when you plan for worst case scenario. Well, I said worst case, best case, right? Plan to live to 100 or 95, right? And plan to have money left over when you're done that you can, use as an inheritance for your children. And if you end up using it, then you end up using it, right?
Yeah.
But you'd rather have more at the end than go down to zero.
Yeah.
That would make me nervous.
Yeah.
Going to zero would make me nervous for sure.
Yeah. Well, I mean, at that point, then you're doing, what we were talking about a while ago is like, then you are living off of Social Security and that's it.
Yeah.
Like then that's worse.
Right. You see, I don't even think about Social Security. It's like, you would still have Social Security coming in. That's true. Maybe.
Yeah. Fingers crossed. But yeah. So I do have a quick, and feel free, like, you don't have to answer this if you don't want to. So personally, your kids are what, teenagers, early 20s?
No, I've got a 33-year-old and a 30-year-old.
Okay. So are they into investing at all? Have you like told them the importance of this? Did they learn it on their own?
One of them has dabbled in it. But I don't know that seriously.
Okay.
And the other, her husband is interested in. My son's dabbled, and I think my daughter's husband is interested in it and doing some as well, but I don't know the specifics.
So is that's kind of the thing that you just like stay out of and let them figure it out on their own kind of thing? Or have you told them like, hey, it is kind of like the sooner the better?
If they bring it up, like, it's a topic that I love to discuss. So I'm happy to share anything that I know with them. but I don't force anything on them. They both have 529s for their kids.
Yeah.
So I did ask, like, are you going to be setting up something for the kids?
Yeah.
Because that's part of my budget in retirement is I donate to the kids' college 529s every year.
Yeah.
So that was something that I budgeted for. That, again, we talked about things that you budget for that you didn't need when you were working, like, so in retirement, like I give to, there's 3 grandchildren now, so I give to all 3 of them once a year, just as a gift, right? So I didn't have that expense before, so I factored that into the budget, and just make sure that you can cover those things that you want to do. If you're a person who's going to want to like travel the world every year, then you got to factor that in. We'll probably take a nice vacation every year, and maybe some drive to places, a year, but it's not like we're going to be, in Hong Kong one day and in the Netherlands another day, and the next day we're going to be in New Zealand. Like, that's just not how we are.
Yeah.
But, would we like to go to Ireland? Yeah, we'll probably, like a trip here, a trip there.
Yeah.
But it's not like we're going to be doing massive travel. And I think that's part of just like knowing who you are and knowing what you want out of retirement, and then budgeting for those things and making sure that you're executing that plan to reach that goal.
Yeah, I agree with that. The wife is the one, she's the traveler out of the 2 of us. And it's not that I don't like the travel, but like she has places like out of the United States that she wants to go. And I'm like, there's so many places in the US that I've never seen. I'm like, I want to get like these off the list. I don't want to go to see somebody else's stuff. I want to see my stuff first. Like, I've never been to like the Grand Canyon or like even LA. Like, I don't want to live in LA, but it'd be cool to go just to see it.
Right. Exactly.
And just like confirm I don't want to live in LA, like stuff like that. Like just little stuff like that. It's just like places like Miami. I've never been. Like, everybody always talks about Miami. I've never been to Miami. It'd be cool to go to Miami. So yeah, that's my stuff. Like, not to say that we'll never travel abroad. I do want to do that, but like, I feel like we have so many years worth of like, we have to travel here. We have to go places that I've never seen before. So, and then she likes cruises and stuff like that. So I'm sure we'll do that kind of stuff.
Yeah.
And I've actually, I don't know if this was a book. I might have watched a video about somebody reading a book, but they were talking about the one group of people actually retired and they live on a cruise because everything's all inclusive.
Yes, I've seen that.
Yeah. I'm just like, that's kind of like a life hack right there. Like, everything, like, you don't pay for, like, you don't have a mortgage, you don't have a car, you're on a boat, you literally get unlimited food. So like, you just live on a cruise boat. Like, that's what you do.
Right.
I'm like,
I've also heard of people that like leave the country in retirement because it's cheaper to live in other countries.
Yeah.
And they live on $40,000 a year and they're happy as can be, and God bless them. But there's no way I'm doing that.
Yeah.
No way I'm doing that. I have family here. I have grandkids here. I don't want to live in another country. I like living in the United States of America. Like I it's not for me. So again, just knowing what your personal goals are is like paramount to understanding what is enough.
Yeah. Yeah. I agree with that. Okay. So this is a question I always like to ask, and I get like a bunch of different responses on it. So are there any dividend, we'll try to keep it dividend specific, but if it goes to just investing in general, that's fine. But like, are there any dividend or investing specific, like, myths or misconceptions that you hear often that are just like not true that you want to like debunk? So like, one I always hear is like, dividends are for old people, or, wait, like we were talking about before, like wait to plan for your retirement later down the road or stuff like that. And like, we just know that's not true. Like, it's better to do earlier, and you don't necessarily need to be older to invest in dividends. I'm doing it and I'm 29. So.
Right. I think the only thing I would say about myths is, and I don't know if I would consider it a myth, but you hear like people parrot what famous investors have said. In other words, time in the market beats timing the market, or, just different, like, well, dollar cost averaging, lump sum is better than dollar cost averaging. And people just kind of like spout these like little sound bites. And I think what the myth is that they're right, because the answer is it depends. Right? It depends on the situation, and every answer, that's not the answer to every question. And people just like say those things over and over again. And it's like, well, there's such a thing as value investing. So like if I would like to buy on a dip and I'm going to wait a little while because I think it's going to go down. Now I don't have a crystal ball, but you can't leave your intelligence like in the back room just because there's this saying that says time in the market beats timing the market. It's like, well, no, you also have a brain and you should use it. And if you know what the economic situation is in the world and you listen to analysts and you keep up on the news, you would know that, okay, like they're going to be cutting rates, right, this year in 2024. Well, what's that going to mean, right? Well, that could mean that REITs are going to end up doing better in the second half of the year. Now, I don't know if that's true or not, but that's what that could mean, right? So, because, REITs do better when you have low interest rates. So, am I going to like stock up on my REITs now because they're on sale? Yeah. Am I going to buy my REITs when they're high? No. Am I timing the market? Kinda. So it's not wrong to do that. And I think it's important to buy when things are on sale and to try to get the most value for your buck, and I'm not against dollar cost averaging. Like if you're putting money in your 401k, that's like regular investing, investing weekly, things like that. But I don't think you should check your intelligence and all of the information that that's going on in the world and just follow these mottos that people parrot at you on the internet. I think you can make more intelligent decisions.
Yeah. Well, and the biggest thing about those mottos that people just say is I always say like, there's literally a saying and then there's sometimes a equally popular, but sometimes less popular counter saying. So like the example is like early bird gets the worm. And then some people say good things come to those who wait. Those are two very popular sayings that are literally the opposite thing. So like when you talk about like dollar cost averaging or value investing or whatever it is, like the thing that people don't often consider is like, if you are going to say you're a value investor, what are you doing with your cash while you wait? Like, because there's like, are you sitting there waiting? Say you think Costco is overvalued at $670 or whatever it is right now. You want it to be 500. Cool. Are you sitting there with the money that you're going to put into Costco, or are you putting that in a different opportunity while you wait?
That all depends. Like right now you've got Fidelity paying 5%, right? Yeah. So I'm okay waiting a couple weeks or a month making 5% because that's probably more than the dividend I'm going to make if I buy Costco. As a matter of fact, I know it is. So I'm okay. Like, no, am I going to get capital gain? No, but if I'm waiting a couple weeks or if I'm waiting a couple months over 20, 30 years, does that really matter? Probably not. Right. So why not buy more of that stock for less money? Yeah. And that's where like people, I think when a stock goes down, as long as it's a really good company and they still have a good forecast, it's on sale. Yeah. Run towards it. People run away from it. Yeah. And so that whole, like, when people are running away, you should be running towards. When they're running towards, you should be running away. Yeah. You might have heard that one, but it just depends. Like if the stock is down because the company like MPW is in trouble, well, maybe you don't want to run towards that, yeah. but maybe, I don't know, maybe you do. Maybe you want to lower your cost basis. And so you invest a little bit while you're waiting to see if it's going to turn around and lower your cost basis. Yeah. But you may not be putting huge amounts of money into it, right? Where something else like Realty Income, it's a symbol O, it's a REIT, and it's on sale right now, like big sale right now. And as interest rates get lower at the end of 2024, it's going to rebound because it's like there's nothing wrong with the company. It's on sale just because of the interest rates were up. So I think understanding like what's going on in economics too plays a role in making sound decisions when you invest. And not that, you're not going to make mistakes. You're going to make mistakes. But you learn from those mistakes and you move forward. So
Yeah. Yeah. My biggest thing, like I made that video a long time ago that talked about like stock price doesn't matter. And people were like thinking that was clickbait. And the reason I said that was because of, and obviously this depends on your timeline too.
Mhm.
Like what stock price is for me is not the same as what stock price is for you. But like the two reasons behind it, spoiler alert, was like dollar cost averaging and fractional shares. The fact that you can do fractional shares now, like you don't need to, like, I give this example all the time. Imagine trying to save up for one share of Berkshire Hathaway. Imagine doing that. Like you'd just be waiting your whole life to get one share like that. You'd literally would never own anything. But so it's one of those things where I like, those are the two reasons that I believe that stock price, because so when I bought Costco was considered to be overvalued. Allegedly,
I think it's like, always overvalued.
Yeah, exactly.
It?
So like, and that's the thing that makes it so hard is when people are certain kinds of investors is like, okay, I'm waiting. Like I don't know if you've seen it on the groups or not. I tell this story all the time. I remember when I first joined, I think it was just the Dividend Growth Investing group, the one with the Monopoly card on it. They were talking about there was a couple guys in there that were like, oh, you know, I had a certain price target on Apple and I thought it had to hit this price target in order for me to buy it. That's what all my numbers were saying. So they never bought it because they were waiting. It got close, but it never got there. So they never bought it. And I'm like, okay, so you missed out on thousands of % gain because you wanted it 2% cheaper.
Right.
And I'm like, that doesn't make sense to me. I'm like, that's the opportunity cost. We're like, okay, yeah, you could have bought it 2% overvalued, but now you made 1,000% gains. I'm like, that's worth it.
Right.
So, and I did the same thing with Costco, and I literally practice what I preach. Like, I don't know a lot of the fancy metrics and stuff. I'm not saying that that's wrong for people to know, but I just don't, it doesn't compute with me. So I was like, okay, my metrics, I'm going to break them down into something I can understand. Costco, when I bought it, I sold NVIDIA. I had extra money. I dispersed it throughout my portfolio to keep me diverse. And then I had X amount of, however much it was, to invest in a new position. Identified a position I wanted, which was Costco. And it was like $4.94 or something per share when I bought it. Like I said, considered overvalued. I was like, I don't care. I don't care. Like, I want to start a position in this. I'm going to put my money into it. I'm going to keep dollar cost averaging. Now Costco's like, I don't know, $6.70, $6.80 a share, something like that. And it's quote unquote still overvalued. But if I would have held my breath, like, you know, Morningstar says it's only supposed to be $4.20 a share, I'm going to wait. Like, I would have missed out on all those gains, a special dividend, starting a position in a good company, like all those things. So
Yep. Right. And that's why, like, these sayings, it's like, well, it just depends, right? Those aren't always true.
Yeah, exactly.
You have to take a case by case basis.
Yeah. I mean, and yeah, so many people, like, with not everybody, with a lot of people in investing, like, following so many books, it's almost like there's like little investing cults where like you have your Warren Buffett people, you have your Charlie Munger people, you have your whatever. Like, I know Chuck Carnival is like the value investing guy for Fast Gas. Like, you have certain people that identify so strongly with a certain person and their style that, like you said, they leave their common sense in the back room and like, okay, this might work, but like, are you on the same timeline as Warren Buffett? I don't know how many people are on the timeline of Warren Buffett. Like, it's
we're not on the same planet.
Yeah, exactly. Yeah, like he's investing like 1% of Warren Buffett's money is more than all of our retirement portfolios. Like, yeah, exactly. So it's like one of those things, and the fact that he's like 9,000 years old. So like he's planning for different things than we are. And like he might be planning for further down the future than we are because he's Warren Buffett. He's got Berkshire Hathaway. He's got all this kind of stuff that he needs to do for decades after he's gone. So it's one of those kind of things. So it's like, it's just so weird to me. Like, I understand following people like that. And to me, it's not even about following philosophies that they say or things that they say or whatever, like soundbite that they want to preach off. It's like, what wisdom can you take from what they've done? Because like, that's what these interviews are about, is like, there's things that you've done, mistakes you've made, mistakes I've made. We're talking about them. Somebody else watching this can be like, hey, that's a good point. I need to check my portfolio for that. I need to make sure, oh, okay, I'm getting close to retirement. Maybe I don't need to move 100% of my portfolio into income. I can do percentages like you were just talking about. Like just little stuff like that. Like it's in like, I always say for like mistakes, like everybody's going to make mistakes. Ideally, you want to make the mistakes early because the mistake costs less. If I lose 10% of my $100 portfolio, I lost $10. If I lose 10% of my $1 million portfolio, that hurts a little more. It's the same 10%, but the mistake cost a lot more. So it's like, do you want to spend $10 on a mistake or $100,000 on a mistake? It's the same mistake, but it's 10%. So it's one of those things that like and the best kind of mistake is the one that you spend money on and I get to learn from it. I don't have to lose any money on it. Like that's the best one. Like, okay, you lost $10. I didn't lose any money, but that's a good idea. Like that's a good idea. So
well, you brought up like diversifying, like having money in different places. And I think that, you know, it's good to be diversified. You know, I don't think too many people would argue that fact, but you know, I think how you diversify, there's multiple ways to diversify, right? It's not just by sector.
Yep.
I own something in every sector, you know, so I've got the sectors covered, but like, I don't own them at the, like if you go in Fidelity, it'll say, okay, well, the S&P, this is how the S&P is divided by sectors, right? So you should kind of align your portfolio to how the S&P is aligned.
Just buy the S&P at that point. Like if you're going to do the same exact thing.
You know, and at first I was like, oh, okay, you know, I need to do this. And so I would try to like do that. And then, you know, I was like, okay, wait a minute. Do I need to do that? Because if I do that, I'm not executing my strategy, you know, and so and then I'm not going to meet my goals. And so then that's when I realized that, you know, it's okay to not be invested in the sectors at the exact percentages that the S&P is invested in those sectors, that you can tailor it to your needs, right? And so as a retiree, or at the time soon to be retiree, I was, you know, going into more defensive stocks, more lower beta stocks, more income producing stocks, but like utilities, REITs, consumer staples, things like that, that even in a down market, you know, people still need to buy groceries, you know, things like that. And so I think you should be diversified. And that's why we talked about having some of your money tied to the index.
Yeah.
And that's going to instantaneously diversify you. Or if you have ETFs like SCED, you got 104, I think 104, 102 stocks in SCED. And so that helps diversify you. You know, your closed-end funds, any mutual fund you're in, that's going to instantly diversify you. But I also buy individual stocks in different sectors. But I think like another way to diversify too is just by looking at what your strategy is. How much do you want in income versus growth versus income and growth? And the other way I've started to diversify too, or really balance the portfolio, is to examine what percentage of my income is coming in from a particular investment.
That's my biggest tip for people that are at that point, is like it's almost not that it doesn't matter, but I think there's a certain point where the areas you're getting your income matters more than the diversification of your stocks and your sectors. Because like, so if you are invested, like I don't own any stocks in communication services or real estate. Like in my taxable account, I don't want to own any real estate because it's not tax efficient. And I own a house and I own VNQ in my Roth. So like that's covered. And then I just personally don't like any stocks in communication services. Like I'm not going to be forced to own AT&T or Verizon or T-Mobile or I don't like any of them. If I did, it would be like Nexstar. I like Nexstar Media Group. They just announced like a 25% dividend increase too. But that was when I talked about like, I don't know, a year and a half ago on one of my like Versus series. I talked about that one. But I think that's such I'm glad you said that, because like people, especially when they hit the point in life that you're at where you're actually drawing from that, I'm like, imagine that, because I see so many, I don't want to call them kids because they're adults, but like they're 21 years old. They just started with dividend investing. Kudos to them for starting so young. But like they have, first of all, they're yield chasing at a young age, when I'm like, growth is your friend right now. Like you can get so much more out of your thing. But then like they'll show like their little pie chart and like where their money's coming from. And I'm like, okay, you made 80% of your money from Tesla and or from TSLY and AT&T. I'm like, first of all, those aren't, in my opinion, humble opinion, those aren't stocks you should own at 21 years old with 60 years left to go.
No, aggressive growth has got to be the name of the game at the beginning, because that's where you're going to build your foundation. That's where you're going to build, you know, what the dividends are going to come from.
Yeah.
And there's more than enough time to transition into dividend investing. At the same token, I wouldn't say you can't be a dividend investor with a portion of your portfolio.
Yeah.
but it should be a smaller portion of your portfolio.
Well, people are
right?
worried about making $100 a month now when they don't need it. Like, I don't care what you're like. You found out you were making 30K on accident.
Right.
So like, it's one of those things, like if you focus on the right thing, you'll end up getting where you want to go anyway. It's just all about focusing on the results and the day-to-day process of like understanding the discipline of putting the money back and stuff like that. And like, it's one of the, like, so what you're talking about with like diversifying your income sources, imagine having 80% of your money coming from TSLY, which do whatever you want with that. And then with AT&T, I'm like, AT&T just cut their dividend by 50%. So if you're at the point like you are where you need your income and you take a 50% cut in income, you're screwed.
Right. So I try to make it so that no one stock contributes more to my income than 4%. So that I'm looking at diversity of income, not just diversity of investment, because those aren't the same things, because they pay different percentage of dividends. So that's what I look at too. A couple tools I'd like to mention that help me make these decisions because I need help, right? Like you, I'm not a financial analyst. Can I make my way through a balance sheet? Yeah, probably I can. I've taken accounting and I've, have my little financial statements cheat sheet of what's a PE, that kind of thing, right? But I like tools because it helps me not have to get into those technical details as much. So I use Simply Safe Dividends. It's a subscription that you have to pay for, but I don't have somebody managing my account who's charging me. What do they charge to manage your portfolio?
A lot of it's like a flat 1%. I'm like, people don't think that's a lot. But yeah,
it's a lot.
Yeah.
It's a flat rate, and I don't know if it's 1, 2, 3, 4%. I don't know what it is, but it's a lot of money, and it's every year they charge you. It's not like one and done. It's like they keep taking this money. So the subscription to like a Simply Safe Dividend is pennies compared to what if you were having these professionally managed. So if you're going to manage your own portfolio, you should invest in some tools that will help you make smart decisions. Simply Safe Dividends is one of those tools that I rely on. It tells me, it rates the dividends for the stocks if they're very safe, borderline or unsafe type of situation. So right away what to stay away from there. And there's screeners in there. So you can screen for other things like beta or timeliness, like is it on sale right now or not? There's all kinds of things that you can screen for, even like the financial PE ratio, free cash flow, that type of thing. So it's really worth it because it can like really zero in on, okay, well, here's the things that meet your criteria, right? Another tool I do use, you mentioned Chuck earlier, I do fast graphs. So that's another thing that I check when I'm interested in something. I'll, do a screen, and then I'll check out what it looks like in fast graphs. I'll check out what the analysts are saying and how often are they right, how often are they wrong, how many of them are saying this or that for the next 2-3 years. How is it done? Is it selling below its PE? Is it selling over? Like to get a sense for, what has it done over time? And when it's gone down, how many years does it take to usually, or months, to come back up? And then when does it come back down again? And that fast graphs really helps you see all of that over time. And so I have found that as a very, very good tool to use. And I run everything through that, as well as Simply Safe. And then there's another site called Alpha Spread, I think it's called. And that gives you a lot of information about valuation and what analysts think about it and whatnot. And then for free, it's Dividend Channel. I don't know if www.dividend channel.
I use that every week for my Power 5. Yep.
And I go to one thing and one thing only, which is the calculator. And I always pit like two stocks against each other. Like if I'm making my mind up about 4 or 5 stocks, I pit them against each other to see, okay, which one has returned most historically. Okay, well, this one's returned most historically out of all of them. Let me see where it's falling in fast graphs. Let me see where it's falling in Simply Safe Dividends. And I kind of use these tools to say, okay, I've checked all my boxes. I've done my due diligence. I feel good. this meets my strategy because let's say I'm trying to beef up my income area or I'm trying to beef up my growth area, to get those percentages that I want. So if it meets my criteria and it passes all of my due diligence, then it's like, okay, it's something that I should add to the portfolio. A lot of time, I'm trying not to add anything new at this point, though. I'm trying just to add to what I already have, because as you get more and more, it gets a little bit more difficult to manage. So
that was one of my like tips or like learning things when I first started is I like spreadsheets. I called something a T score. I was like, oh, this is the Troy score of whatever. And I was literally just like, here's all this information. Here it is compared to other stocks in the same sector. Here's which one ranks the best in whatever information I'm sorting by. And I rank them, filter again, do it again. And like kept doing that. I made like a test portfolio of like the highest T scores, the lowest T scores, and was just like back testing them. So like Portfolio Visualizer is really good for that. Like the back testing. And then obviously Seeking Alpha. You didn't mention that one, but like I use that all the time. Like Seeking Alpha is really good. And I use that for free too. So,
okay. Yeah.
But,
I read a lot of articles on Seeking Alpha, but I think you get like 3 free articles a month or something.
Yeah, it seems like I'm always out of free articles every time I click on something. But
yeah, I know.
So for Seeking Alpha, you can actually do that thing. I think when you're on a stock, you can go to an area called charting, and then you can compare. So like one that I've recently talked about is like a lot of people like, oh, like you were talking about Realty Income. One of the stocks I just mentioned on the video that came out at this time yesterday, it was ADC. It was a stock I haven't heard of before. It's a REIT. It also pays monthly. It outperforms the S&P 500 and it outperforms Realty Income. It has a better dividend growth rate. It has a better 10-year performance. It, like I said, it also has the same frequency of payouts. And it's just one of those things where in one of the dividend groups I'm in, I was just talking about it. And I was like, part of me feels like Realty Income is just like the most popular because of how it's marketed. Where Realty Income, it's the monthly dividend payer. That's their slogan. And they also raise their dividend quarterly. But the raise that they're giving quarterly, when you actually step back and look at it, it is fractions of a cent just to say they're raising it quarterly. So they'll go from paying 29.90 cents to 29.95 cents. And I'm like, you literally don't notice that. But over the course of time, when you pull out, it's actually giving like a 3 to 4% dividend raise. Like that's what it's doing. So it doesn't matter if they're doing it quarterly with their little fractions of a penny, or if I'm giving you this stock that's going to raise it by 6%, it's already more. Yeah, you're not getting a quarterly raise, but you're really not getting a quarterly raise with Realty Income either. Like it's not like the amount of shares you have to own in order to even notice that quarter of a cent that you're getting. Like it's not anyway. So like
I think with REITs, you have to be careful. Like who are the renters?
Yeah.
Like how are they making their money?
Yeah, exactly. Like what's their unit that's paying them the rent? As far as like, is it businesses? Is it private?
Because there's a lot especially with COVID and people working from home. I'm like when COVID hit, I worked from home ever since then, 5 days a week. And a lot of people do. So what's happening to these buildings? These commercial buildings are all getting sold off. And so if you have a REIT that's owning commercial buildings, now's probably not a good time to be in those REITs, but if you have a REIT that's owning things that are defensive, like drugstores and like Lowe's and Home Depot, things like that, where, they're going to be around because people need them to survive. Right. It's not high rises and commercial buildings, that type of thing. I think it's important, like not all REITs are created equal, and you want to understand the business, like how do they make their money? And is that a risky way to make money, or is that a pretty safe way to make money?
Yeah.
So that's where, again, what's your goal? Is your goal the higher yield? Is your goal the lower beta? So, you might like this one that you mentioned, I'm not familiar with, but it may be more risky. And right now I don't want risky, so again, it depends. What's your timeline and, all of that. So that's where you have to look at all these other factors.
Yeah. Yeah. And that's one of the responses back from one of the groups was just like about the stability of it. And and I was like, I agree with that. and one of the guys commented back, and it was one of those things where they were commenting on it last night, and I didn't want to comment on it this morning because like it's already everyone's already moved on, so I'm not gonna be that guy. But I was like, and the one guy brought up the point I was gonna make was like, okay, stability's fine, but like year after year after year of 2% stability, I don't know how, like that's not, in his opinion, in my opinion, that's not like the kind of stability I'm like. At that point, you're losing to inflation with your stability. So I was like, okay, like it is about, like you said, it's about like understanding like your risk tolerance and also like what your desired outcome of is. And so, and you can look at like, I'm not at the point, like my portfolio yields at like 1.97%. So I don't, and like I said, I don't invest in REITs in my taxable account anyway, but yeah, you can look into ADC and see, I don't know, it might be good. And you said you're not trying to add new positions anyway, but yeah. So, but yeah, all that to say, Seeking Alpha has an area called, you can chart and you can literally, I put up, O was the one I looked up, and then I pulled up ADC, and it's kind of like Dividend Channel where it actually compares it like side by side, and it puts the bars on the same screen. So that's kind of helpful to see.
That's cool. Yeah.
Okay, so is there any questions that I didn't get to ask you that you wanted to talk about or anything like that, or you want ready to wrap up?
Let's see if we covered everything here.
I skipped around a little bit in the thing because it was like, we touched on it here or there, but yeah, if there's anything that you definitely want to talk about, let me know.
No, I think we pretty much hit on everything.
That's good.
Yeah.
Okay, so then I have the last question for you.
Sure.
So somebody's going to start investing today. They're going to do dividend investing, not necessarily dividends for income, but they're going to do a version of dividend investing, whether it's dividend growth investing, whatever. So other than just get started, what other tips, tricks, advice do you have for somebody that's going to start investing today?
Well, first of all, invest in yourself. Read and learn about it before you dive in. That would be the first piece of advice I would give. The second piece of advice is if you have access to a mentor that knows more about investing than you do, take advantage of that, because I have a mentor and it has helped me tremendously. When I, just random information that they were able to share with me, I would take copious notes, and refer back to over and over again. So it's good to have somebody. Surround yourself with people that know about investing so that you have a group of people, whether they're friends or relatives, that are willing to share information with you, because you don't want to do this in a vacuum, and you don't want to follow what somebody on Facebook tells you to do. That's for sure. Okay. So, and if you don't want to pay, tons of money to have it your portfolio managed by a firm, you have to invest in yourself and get a good mentor, and then just start, know what do your due diligence, whatever that means to you, however you do it. If you do it like I do, where you subscribe to these different things and, look at them through Simply Safe Dividends or Seeking Alpha or, fast graphs, things like that. Or, learn how to read the balance sheets and the financial statements on your own. But, don't buy something just because, I've always buy Toyotas and Lexus, so I'm going to go invest in Toyota and Lexus. That's not a reason why to buy that. I like their cars, but I don't own their stock. Not to say that their stock's not good. I'm just saying it never met my criteria. So, invest in yourself, get a mentor if you can, and just start experimenting, start doing it and see what happens. Really know thyself, right? Like know what your risk tolerance is, and then have that, don't have that instant gratification mindset. Have the long-term mindset of, like you said, hey, I wish I could see what it would be like 30, 40 years from now if I do X, Y, or Z. Have that conversation with yourself in an Excel spreadsheet and sit down and figure that out. Search out some tools online or with your broker to figure that out, and put a plan in place and then execute on that plan and do it diligently, make it a habit. And again, if your personal finance world is a mess, go deal with that first, because then you can invest unfettered, and you don't have to worry about it, taking away from the necessities of life.
Yeah. Yeah. I personally know people that are, spending $600-700 in minimum payments every month on, credit cards and stuff. And I'm just like, you gotta that's $600 to $700 that you can clean up, and not including the average interest rate of a credit card's 29% or whatever it is. Like, you're not going to get that return in the market. I don't care what you're investing in, like, at least consistently. Like, yeah, you might have a great year from Tesla or Broadcom or something like that, but like over the course of 10 years, you're not going to get 30% every year. Like, odds are not likely. So, I agree with all those tips. It's important. I always tell people, again, not professional advice, whatever, but I always tell people, like, if you have no interest in investing, it's still important to start.
I was going to say, like, a lot of it has to do with interest.
Mm-hmm.
Like, are you interested in investing? Do you have a passion for numbers? And does this type of thing get you excited?
Mm-hmm.
Like, it gets me excited. I like talking about it. I like doing it. When I spend time looking and researching stuff, I don't feel like it's time wasted. I feel like I'm having fun.
Mm-hmm.
I'm enjoying it. But some people just don't have any interest in it at all. And if you don't have any interest in it, and if you don't feel passionate about it,
ETF,
VOO, QM all day long, every week.
Yep.
Just start doing it, set it, forget it. You'll be glad you did.
Yep. That's one of the tips I give at the end of like every episode, is just like, because like what you can do with that is, like, worst case scenario, you put that money in there, you never worry about it. It just goes in there all the time, and you'll be happy you did 40 years from now. Best case scenario, like, you'll look at it like, man, that's cool. I get to see that this is growing. Like, what makes up VOO? Like, why is it successful? Then you're like, oh, okay, Apple, Microsoft, like all these companies are in there. Yeah. That's cool. And like, oh, okay, like these are in different sectors, and you start like learning, oh, what VOO pays me a dividend? What's a dividend? And like, you can start going down a rabbit hole if you wish. And like I said, worst case scenario, you don't give three craps about none of that stuff, and you still have a good fallback plan. Best case scenario, you do care about that stuff, and you can educate yourself, all while still having money that's growing in the meantime.
And there's like Investopedia, right? It's like a investment Wikipedia. Mm-hmm. You may have seen that. Yep. Read articles on there, look stuff up. Yep. And I think, like, if you're passionate about it, you'll do it. If you're not, that doesn't mean you can't invest. Like, I was like I said, for the first several decades, I just invested in whatever mutual fund my company had available to me. I took make sure you take your company match, 100% of your company match. Don't leave that money on the table.
Yep. That's a free 100% return.
Yeah. Take that match every day, all day long. But when you're younger, aggressive growth. And then as you get older, you start switching over to, that income strategy. But it doesn't mean you can't buy dividend stocks when you're younger. You absolutely can. And if you really don't know what you're doing, get scared. You can't lose.
Yep.
There,
SCHD, right?
SCHD, yeah. And Schwab's, I think it's Schwab. But that's their dividend fund. And, it pays like, I don't know, is it like 3.5 or 3.8?
3.5 or something like that. I think the S&P is always around like 1.6, and then that one's always around 3.5.
Yeah, and it had a bad year last year. Everybody realizes that. That follows this, they would realize that. But, it's doing really well this year. So, like everything else, it has its ups and downs. But, the trend continues up, right? Mm-hmm. And that's that bigger picture of, we're not day traders. We're investors. There's a difference. You have to understand, are you trying to be a day trader, or are you trying to be an investor? And if you're trying to be an investor, you want to invest in solid companies that meet your criteria, that you're going to hold for a really, really long time. Mm-hmm. The goal would be forever.
Yeah.
But, sometimes it doesn't work out. Right. So, but that would be your goal.
Yeah. Yeah. I agree with all that. So, well, anyway, Michele, I wanted to say thank you so much for taking time out of your day to speak with us. It's been a pleasure to meet you finally, and also to hear your story and all the wisdom and stuff. And also, like I said, again, congratulations on retirement early. Congratulations on the grandkids. And anything else you have to say to wrap us up for the day?
No, it's been a joy talking with you, Troy. Thank you for the opportunity. I hope, people can take away one or two things maybe that they hadn't thought of before and put it to use. But just have a great day, and thank you for your time.
Yeah, thank you.
And that's going to wrap up this week's discussion. I really hope you enjoyed my conversation with today's guest, and thank you for spending part of your day with us. Remember, if you want to be on your very own episode of Dividend Discussion, make sure you reach out via email at dividendobsession@gmail.com, and I'll be in touch. But until next time, see you.